Welcome to our November monthly investment update. I am Michelle Smollenberger, the CEO and a financial advisor here at Financial Design Studio.
And I'm Robert Stoll, and I am Chief Investment Officer and also a financial advisor here.
Thanks, Rob. So anyone who is already working with us, for you, our clients, you already know us, but anyone listening who may just be being introduced to us now, we wanted to let you know who we are and why we're recording these videos. Really, the point of these videos is just for you to be able to hear our perspective on anything that you're hearing in the market, the economy, anything that you might have questions about. And because we're investing for you, we really want you to hear our opinions, our thoughts, how it impacts, any investment decisions, things like that. So we thought this would be helpful just for you to know how to talk about these things, even when you hear about them, with friends or family, especially as the holidays come up. These will be some things that people might be talking about over Thanksgiving, right, Rob?
Exactly. Yep.
If you missed our October video, that was October 22nd, you can go back and watch that. We're going to link to that here too. So you can go back and listen to that one as well. We covered some topics like AI, stocks, and things like that. So feel free, if you miss anything, to catch up on those. But we will be doing these monthly so you can hear our thoughts on recent things. So since October, it's really only been like 3 weeks since we had our last video, and it feels like a lot has happened. Do you want to just kind of give us kind of like a market update since that last update, kind of talk about how the
Yeah,
market's
sure.
been performing?
Yeah. It has been pretty quiet despite the headlines with the government shutdown, and then we had elections a week ago. If you look at the stock market, the S&P 500 is up about 2% since mid-October. Gold is up 2%, and bonds are down a little bit. Really not a lot of volatility. That's been characteristic of the market most of this year, outside of April when tariffs were initially announced. There was a big downdraft and then a huge rally. But the last several weeks, volatility has been very, very low. And that's continued, even with all the headline risk that we've seen coming out of DC lately.
Yeah, that's nice. We like to hear that. The market just keeps doing what it's doing, regardless of anything else that's happening. Agreed. Let's talk about the government shutdown. That's been going on now, I think, for about 6 weeks. So let's kind of hear updates to that, how we think if there's any market impact or any impacts otherwise.
Yeah, it's remarkable when you think about it. The government shut down on October 1st. As we're recording this on November 12th, they should reopen it today. So probably by the time everyone hears this, the market or the government will be reopened. And despite all that, that was the longest shutdown we've ever had in US history. The stock market and bond market really took it in stride. So all stocks, bonds, gold were all up since the shutdown started on October 1st. And in terms of impact, last month when we did this video, you had asked, when do you think it'll end? I suspected that the healthcare enrollment for Obamacare starting on November 1st would be the catalyst. It turned out that Election Day was a catalyst, so a few days after that. But where we're sitting now, the government is reopening. There really wasn't a lot of change, I guess, relative to what was going to happen anyway. And I will kind of talk about healthcare premium tax credits. That was a big sticking point, that the Democrats wanted to extend those. The Republicans were of the mindset to just let them sunset, as they were scheduled to do at the end of this year. But
Mhm.
other than that, I mean, there really wasn't anything new that came out of this.
Yeah. Well, let's go ahead and talk about, so basically the Affordable Care Act, those subsidies that basically were scheduled to end. And so that was what they were trying to get changed. Talk us through like who that will impact and what that looks like.
Yeah. These subsidies, they are important. We have several clients that have retired early before Medicare age, and they get their health care off of the marketplace. And depending on one's income, there could be substantial help in terms of paying the premiums. If income is lower, that scales down as you move up. But if we look at this chart that I put together here,
Mhm.
so this kind of shows you how these premium tax credits work. So when Obamacare got passed 15 years ago now, they put in a provision in there that if your income was low, that you would get help paying the premium on your health insurance. very simply, if you logged on and it said, oh, your monthly premium is going to be $1,000, if you were at the low end of the income spectrum, they might say, well, your premium is $1,000, but we will give you $700 to pay for that. So your actual out-of-pocket cost is $300. And so what you see here is how this works is the premium tax credits look at everyone's income relative to the federal poverty level. So here I just took the example of a two-person household, married couple, for example, and the federal poverty level is 21,150. And the reason why I have the triangle going down is because the higher your income, the less premium tax credit you get, i.e., the less help that you get. And everything in green is what was established in Obamacare originally in 2010. And that basically the subsidies, they call it a hard cliff. It's like as soon as you are a dollar more than that 400% over the federal poverty limit or 84,601, you would not get any premium tax credit help whatsoever. A couple of years ago, during the Biden administration, they had passed and extended as part of the Inflation Reduction Act that we will extend these tax credits above that 400% federal poverty level. For a lot of people with incomes above, call it from 84 to about 170,000 ish, those people who previously were not able to get premium tax credit help were getting it the last 3 years. So the big fight coming into this shutdown was that provision that highlighted in red here, that was expiring at the end of this year, and it was going to revert back to the old rules, everything you see here in the green. But they did not come to a resolution on extending that. As part of the shutdown, the Republicans and Democrats agreed to talk further on this in December and hopefully work something out. But honestly, I think at this point, I would not be surprised if those enhanced tax credits don't come back at all. And so we're
Mhm.
just back in the old rules. And I would say if your income is, in within that under that 400% federal poverty level, you're really not going to notice a difference other than premiums just generally going up. It's not like your premium tax credit is going away. It's really the ones impacted by this are the ones that had income above that 400% level, that they were last 3 years getting some help to pay premiums, and now that's going away, which could be jarring because we
Yeah.
all know health insurance premiums go up every single year and they've gone up a lot. So not only are those people going to have the health insurance premium increase, but they're also going to not have these tax credits helping them anymore.
Yeah, I think that's one of the interesting things to note is that federal poverty level is really low, and so people getting help need help at that level, and so that's where it's like this is where it really does impact real people on a real level, and so I think that's where it's hard because we need to make sure that we are caring for people. There is something for those that really need it. So
Yeah, exactly. Yeah, it is. And I mean, there is a lot of debate about as subsidies go up, premiums also go up, kind of like college tuition, the way that's worked out over the last 20 years. Um, the system needs to be reformed. I don't think there's any doubt about that. And if
mhm.
you get both sides in the room together and
Yeah.
take all their phones away and they're able to speak freely, I think everybody knows the system is broken. Maybe what comes out of this is something that works out a little bit better for everyone because it's frankly it's insane. I mean, we have clients that their monthly premiums are like $1,500 for
Mhm.
what's really not great health insurance. That's not a sustainable situation in my mind.
Yeah, I think, yeah, at the end of the day, this is kind of something that we know needs fixed in a much larger way. So this is just kind of what was being debated or the thing that was being talked about now is the subsidy, whether to continue, whether not. But it's kind of one tiny problem and a really big problem. So the real hope is that they could actually create something that could help everyone and make it better for everyone. All right, so this is kind of like rapid fire, Rob. We're just kind of going from one topic to the next, to the next, to the next, so we can
Let's
cover
do it.
things. Okay. All right. So next topic is interest rates. This is again something we probably talk about all year long, but why don't you kind of give us an update on where interest rates are at right now?
Yeah, yeah. So the Federal Reserve met 2 weeks ago, and as many in the market expect, expected. They did cut rates by 0.25%, a quarter point. Um, Really, the big surprise coming into it, like as we went into that meeting, there was very high confidence that they would cut by a quarter point in October, but also at their December meeting, another quarter point. And during the press conference for Jerome Powell, he's the Federal Reserve Chairman, he made remarks that kind of poo-pooed the idea that the December rate cut was basically in cement, and there was some uncertainty about it. So there was a little market hiccup for like a day or two after that because honestly, the market is pretty addicted to low interest rates. So anytime there's mention that they might not be going down as the market expects, they don't like that. And sure enough, I mean, if you actually look at what the market is expecting now relative to what it was right before that meeting, you can see in this very, very light blue, if you look all the way to the left at that's labeled 350 to 375, 3.5% to 3.75% on their federal interest rate. You could see a month ago when we did talk that that light blue bar was at about 90% odds that they would cut by a quarter point at the December Fed meeting. But from where we are right now, that's just over 60%. So I would personally be shocked if they didn't cut again in December, especially with the fact that we haven't had a lot of economic data come out recently due to the shutdown. So I still expect them to cut in December, but it's less of a slam dunk now than it was when we spoke a month ago.
Yeah, no, that's helpful. Yeah, it's interesting just to kind of know where we were going and where we were expecting to, but then when they do make a statement like that, that kind of changes a little bit what people are thinking.
Yeah,
Something
and
too.
I mean there should be more cuts going into next year. The big debate amongst Fed watchers these days is what is a normal level of Federal Reserve interest rates, and we're at 3.75 to 4% right now. I think most people view that as above normal. But the debate is there's some people that think it's as low as 2%. Other people think it's like 3.25%. So that as we head into 2026, that's going to be the big debate.
Yeah.
I still think interest rates will come down, but how far they come down and how quickly will be the big question that we grapple with.
Yeah, yeah, no, that's helpful. Something else people might not have realized that we were even just talking about this morning was that because of the government shutdown, the Social Security cost of living adjustment has not come out yet for 2026 because they haven't had data reported for the last couple of months, right?
Yeah, yeah, and it's usually that does come out late October, but the data, the way they figure out that cost of living adjustment is they take a 3-month average of July, August, September inflation rates. But the problem is the September inflation rate has not been reported due to the government shutdown. So that should be out soon, but that is one practical delay that we've seen from the government shutdown is we don't know what the Social Security COLA is going to be, the cost of living adjustment. It should be just under 3%, I think, but maybe like 2.7, 2.8%, but we'll have to see what the final figure is once they release data that should have been released a month ago.
It's just interesting, like all these little ways people don't really realize how the shutdown can impact people. And then we started to see it with flights and things. So it's kind of
It
one of
is,
those ways.
yeah, it is. I mean, I've been watching markets for my entire career and all that, and the biggest data point every single month is the jobs report, which comes out the first Friday of every month, and we've gone 2 months without, what is the biggest market moving data point we get out of the government. So they'll be coming out with that probably in a couple weeks, but it is, we have been kind of flying in vacuum here for a little
Yeah.
bit.
Yeah, no, it's interesting. All right, we're going to shift a little bit because there has been a lot of buzz around gold recently. Kind of just walk us through, remind us like why people buy gold, what are people
Mhm.
talking about, what's the buzz around it?
Yeah, so gold, I mean, as far as investors go, gold has always been a really interesting asset to watch because there isn't, when you look, when you're buying a company or a stock and you're getting dividends and they're making money, I mean, there's all this financial mathematics that go into, okay, discounted cash flows. I expect these cash flows in the future. Here's the interest rate. Here's what that stock should be worth. With gold, because it doesn't yield anything, it's just, as some people like to call it, a pretty yellow rock. Um, its value is completely inherent to what people are willing to pay for it. But I mean, gold has been around forever. It's always been seen as a store of value. We've had currencies, our own currency tied to the price of gold as recently as the late 60s, early 70s. So gold has always been, I think, an important benchmark for a lot of people to measure concerns about inflation or geopolitical concerns. That's always been the two things that have driven the price of gold higher is people are worried about inflation or they're worried about some geopolitical event. So, you know, gold has always been a safe haven.
Yeah. Yeah. No, that's helpful. And I think it's really helpful, like, kind of like why, when people buy it, like, when we talk about that versus like the current, our currency versus stocks, bonds, things like that, it is something that it comes up, the talk of gold, when things aren't so good and when people are looking kind of for that safe haven. So,
Yeah,
no,
yeah,
that's
and
helpful.
it's obviously been a very big talking point this year. Gold is up about 50% this year, which is huge. It had broken out from the 2000 mark. 2000 per ounce was kind of seen as a ceiling for a long time, and once it got through that decisively, it went up to 3500 an ounce pretty quickly. So
Yeah.
gold has caught a lot of attention this year, and it's been good. And in our client portfolios, we do own a broad commodities fund, about a quarter of it, which is in precious metals like gold. So we've thankfully they've participated in that. But
Yeah.
yeah, I mean, gold itself, it's when it's hot, people love to talk about it, but it will go through 10 or 20-year periods where the price just sits there, it does nothing, and nobody ever talks about it.
Yep, exactly. Which is probably okay because those are times where we're not concerned about things or it's gold. So it's like, oh, okay, maybe everything's okay. So, Rob, can you explain kind of why gold has gone up, like more specifically this year?
Yeah, there's a lot of debate about this right now in the financial community because gold is up so much, and there's people speculating it's about inflation and maybe due to the tariffs driving inflation higher, something like that. But a more interesting conversation of late is around the idea that the currency is being debased. You'll see this word in the financial press every now and then, debasement. And basically what that is talking about is this idea that the governments are spending so much money, they're printing so much money year after year that the value of the currency is just rapidly eroding. And the way people talk about that when it is eroding quickly or could do it is that the currency is being debased.
Yeah.
So there's a lot of people that are looking at the price of gold this year and saying, this is a clear sign that the currency is being debased and inflation's going to go crazy in the future. And, I share all the concerns about federal deficits and printing money and things like that, but I don't really share the debasement worries so much. And one of the things I look at is the market they actually have an indicator that market-based indicator that shows what the market believes future inflation will be over the next 10 years. And that's what this chart is. And this goes back just over the last 3 years. But you can see that the average or the inflation rate that the market currently expects over the next 10 years is 2.29%. And if you look at this chart, this only goes back 3 years, but that's right in the middle of the range. And even if you go all the way back 25 years, this 2.3 to 2.5% future expected inflation rate has been very, very consistent over time. So when I look at that, my takeaway is gold is not going up because of debasement or fears about inflation. Because if this was an inflation story, you would see those break even inflation rates going up, or the market based ones, and they're not. So, honestly, what I think is happening, and it's hard to prove any of this, but if you go back 3 years when Russia invaded Ukraine, the response from the West was to seize and freeze a lot of Russian assets all around the world. And I think the takeaway for adversarial regimes around the world was, if we're going to do something that is going to make the West really unhappy, we have to make sure that we don't have our assets in Western banks or Western markets. So I think gold has gone up because the Chinas of the world, the Russias of the world, and some other regimes have started buying a lot of gold, because it's like, if they do something that the West doesn't like, the West can't come in and pull gold out of vaults that they have in Beijing or Moscow. So,
Hmm.
so I think that's why gold is up a lot, and that's why, I worry about this rally a little bit, that, it's gone up so far and so quick. And, if it's not, to me, it's not really based on an economic phenomenon. It's based more on short term supply demand issues, which could change very quickly.
Hmm. Yeah, no, that's interesting. It's kind of be careful where you have your money. Yeah, buy gold instead of owning stocks, having cash in a bank account.
Yeah, exactly. Yep.
Yeah. No, that's helpful.
Hmm.
I think it's interesting just to kind of like, this is where, when you're looking at charts or looking through just data on a daily basis, you're trying to look for the why. Why is something going up? Sometimes it can be just as simple as, okay, because those companies are outperforming because they're doing well, but it isn't always the case. And so sometimes looking for the why something's happening, it takes a lot of charts and understanding like how things work together to kind of figure out or try to understand that.
Yeah, yeah, and I mean, when you're looking for tops, and whether it's gold or the market or something like that, you always look for interesting social markers or anecdotes that come up. And I'm not on TikTok, but I did see the other day there was a TikTok of somebody who went to Costco, where they sell these gold bars,
Yeah.
and they had the price of the gold bar on there, and they're like, oh, it's like $100 below spot gold that's trading in the market. And then if you buy it with your Costco credit card, you get a couple percent off. So there was like this whole TikTok video about this $150 arbitrage on
Yeah.
buying this gold, and then, in theory, being able to sell it on the market for more than you just bought it for. And it's like, I look at stuff like that, and I'm like, okay, I mean, we're near the point where
Yeah.
things are probably a little frothy, and, the market might be topping off here.
Yeah, it is. There are certain behaviors that everyone's getting into it, people that, wouldn't normally make any changes. It is very interesting. There are common behaviors, common conversations, things people say where that just tend to happen when we are near a market top or a bottom. Like you just
Yeah.
know it's kind of around the corner. Who knows, but we'll see. So it is
Yep.
interesting to kind of see some of that. Yeah.
Hmm.
Yeah. All right, so we're going to totally switch now to kind of like very different topic, but one that we've heard like a little bit about. We did hear recently about 50-year mortgages potentially becoming a thing, no longer just a 30-year mortgage. Do you think that'll become a thing, or is it even like, would it even help people? I guess is a good question too.
Yeah, yeah. So the genesis of this, and this was kind of played out in the elections last week, is the dominant theme in our country really right now is that younger people just feel completely disaffected with getting the American dream. I mean, you think about the American dream: get married, have kids, buy a car, buy a home, and eventually retire. And the cost of all these things, cars and homes and mortgage rates, have gone up. It has just become cost prohibitive for a lot of people to get out of college, get a job, and start doing a lot of these things that we've all done. And, I think very rightly, there's a lot of angst about that, because,
Yeah.
we all know, I mean, I'm not that old, but I certainly don't recall having too much difficulty getting out of college, finding a job, and being able to buy my first little small condo right away. So, with that in mind, this theme of young people are angry, cost of housing is too high, what can we possibly do about it? the Trump administration, the head of the Federal Housing Administration, came out with a tweet last week saying, "Hey, we're looking at 50-year mortgages, and that's to help solve the affordability problem." And while I think the idea directionally is okay, it really, I don't think it's a very good idea at all. And I'll just show you this little comparison here between a 30-year mortgage and a 50-year mortgage. Like, what would this actually mean in practice?
Yeah.
So if we just had somebody who bought a house, say a $500,000 house, they put 20% down, they get a $400,000 mortgage on it. Interest rates are right around 6% right now. If you look at a 30-year mortgage payment, monthly payment, that's $23.98 a month. Not exactly cheap, but and then the total interest that 30-year borrower would pay if they kept that house and paid that mortgage off in 30 years would be $463,000. So they'd pay the 400 of principal, another 463 of interest, and then they'd be done at the end of 30 years. If you look at a 50-year mortgage, and again, I mean, the idea behind this is they want to help affordability. And what they mean by that is, how can we lower the monthly payment as much as we can? If this same borrower took out a 50-year mortgage instead of a 30-year mortgage, their payment would be lower by about $300. So instead of $23.98, they'd be at $2,106 per month. It's like, okay, I mean, $300 isn't nothing. But look at the interest that they would pay over 50 years. Their interest relative to a 30-year mortgage would balloon to 863,000.
Hmm.
And you just think about that extra interest that they would pay over the course of their lifetime, another
Yeah.
$400,000 on top of what the 30-year borrower would have, to
Yeah.
save $300 a month. It's kind of like, I don't know. It's,
Yeah.
again, I don't think that solves anything, to be honest with you.
Yeah, well, it's also interesting that if someone's going to take out a 50-year loan, there's even more risk for the lender because that's 20 years longer. So I can't imagine them keeping that 6% rate, but that rate actually be higher, 7 or 8%, because it's for longer. Well, now you have even more interest. So interesting, like I like how you shared that even apples to apples, if it's the same percent, just 20 years longer, it's really not that different, but the interest is so much higher. But what if the interest rate was even higher? So, yeah.
Yeah. Yeah, and I mean, the reality is, and I this is going back a long way, so I'd have to recheck this data, but I believe the average age of a mortgage, like the number of years that people actually hold the same mortgage, is right around 7 or 8 years. So, you could argue that, well, a typical mortgage borrower isn't going to hold it for 50 years. They're going to
Yeah.
hold it for 7 or 8 years. So getting a $300 a month break on the mortgage for 7 or 8 years is like great. Then they refinance into something else, and whether because they're moving or moving up or whatever.
Yeah.
The problem I have with that logic is, and we've seen this, we saw this in the pandemic when interest rates or mortgage rates collapsed and got under 4%, 3%, into the mid twos. What happened? Home prices went up like crazy.
Yeah.
So, that borrower was never really better off because, yes, they were saving on the interest rate, but now they were having to get a bigger and bigger mortgage because home prices were going up. And
Yeah.
we've seen the same thing with cars. I mean, it wasn't 15 years ago, the typical car loan term was, 48 or 60 months, right around there. I mean, now you're at 84, 92 months, like 8 or 9
Yeah.
years on these car payments. And what have car prices done over the last 5 years? They've just
Yeah.
gone insane. And you look at it
Yeah.
with college and tuition costs, it's like the more debt you throw at a problem, the higher the prices go. And
Yeah.
at the end of the day, nobody's better off because the
Yeah.
market, the market adjusts to all this stuff. Prices go up. It's like, well, you can get a 50-year mortgage, but it's the price increases are eventually going to offset that anyway. So I just
Yeah.
personally, I think it's just really bad policy. I don't know what the solution is to get housing down. I mean, people talk about building more homes. I mean, we're definitely doing that, but there was 10 years after the housing bubble where very few homes were being built. So
Yeah.
we're kind of getting caught up with that.
Yeah. Well, I think it's interesting, and these are just things, you hear like a little bit about, but then when we really think, well, does this solve this problem? Does this really help people? I think it's really, helpful to hear, well, what about this? And then if that, then we're actually kind of right back where we started or worse off. Yeah. So I think that's helpful. Thanks for kind of pointing those out. That's good. All right. So those were all the topics that we wanted to cover in this month's update. Thank you, Rob, for explaining a lot of those and helping us kind of understand how to think through them.
Yeah, definitely. And, we do these every month. And as you have questions, any burning investment questions you have, just send them in to us.
Yes, exactly. For our clients, we want to know what's on your mind. So send us an email with any questions so we can address those in our December update. For anyone else who might be listening, thanks for joining us. If you don't want to worry about making the right decisions when it comes to your investments, you can click Get Started on our website to schedule a meeting about working with our team. So feel free, if someone shared this video with you and you want to learn more about us, please reach out and we're happy to have a conversation. So that's it for November, and you can keep your eyes open for our December update.
Happy Thanksgiving.
Happy Thanksgiving.